Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing extreme vehicle battery technology stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Extreme Vehicle Battery Tech is a blockchain and battery technology company with advanced battery management systems designed to meet the growing demand for batteries that charge EVs, wind, solar, etc. The company is headquartered in Vancouver, British Columbia, Canada, and was founded in 2015. It started trading in 2015 and can be found on the Canadian Stock Exchange, Pink Sheets, and Deutsche Börse. The company's technology allows for batteries to perform more efficiently and last longer. Also, a customer can monitor the status of their battery using their smartphone. It is also developing battery recycling solutions by using their technology to analyze and fully refurbish used batteries. Real-time monitoring feeds back into their AI-driven engines, which results in continuous improvement and collaboration for EVs and energy storage systems. If there is a problem with your electric battery, this company can usually fix the issue remotely without sending out a physical technician. If you need a replacement, then its technology can figure out a way for your battery to produce power until a replacement part arrives. Its technology works with blockchain, so the customer can make financial blockchain transactions through its interface. The White House announced a $550 billion infrastructure deal, including $7.5 billion to fund the manufacturing and installation of electric vehicle charging stations. It is the first investment into EV charging infrastructure in the United States and could accelerate the US EV market share to be on par with China, which is 3 times as large. These types of stories usually lift the stock price up. Since ACDC is a Canadian company, it will not get funding from the US, but it may indirectly help them in some ways. The company is expected to equip all Daymak Avenir products with customized Ionix Pro lithium-ion battery packs, which will all contain the company's patented and AI-powered battery management system. Daymak is a large manufacturer of electric scooters, bikes, etc. This is a great opportunity for ACDC. The company really needs to continue building relationships with manufacturers like this to catapult their brand. ACDC has signed an agreement to provide the new Ionix Pro smart chargers throughout an auto mall, with the potential to provide further energy storage solutions and other EV and ESS infrastructure enhancements as the development continues to expand. The auto mall is currently configured for 10 car dealerships with room for future expansion. The minimum requirements call for 2 EV smart chargers at each dealership. The development also includes a flagship hotel, which will require a minimum of 6 EV smart chargers. Discussions with the hotel operators have also included the possibility of an Ionix Pro Titan Energy Core storage system. We're looking at the ticker that trades on the CSE, so all the numbers in this video are in Canadian dollars. Let's get started with the model. This is a microcap company, 110 million market cap. They're trading at 28 cents a share, and they have 399 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they're pre-revenue, so most years they have negative free cash flow. Same thing with net income. It's negative each year. Revenue is a sales for the company, and they did have a little bit of revenue in 2019 and 20, but none in 2021 or the trailing 12 months. This is the company's income statement. The top line is the revenue, the sales. Below that is their operating expenses. Research and development and marketing are a big operating expense for this company. They have negative operating income every year. They do have a small amount of debt, so they pay $3,000 of interest on their debt in the trailing 12 months. That's the most they paid. And the bottom line of the income statement is their net income, which of course is negative every year. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates or loses from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So they did generate positive operating cash flow in 2020 because they bought a lot of products on credit. When you buy products on credit and use accounts payable, that's a cash inflow. But when you pay for the products, it's a cash outflow. They don't spend much in capital expenditures because it's mainly a technology company. They don't have to buy expensive machinery or factories. And they do have negative free cash flow every year except in 2020. So they're mainly funding their operation on capital stock. They issued $4 million in 2019, $1.4 million in 2021, and $7 million in the trailing 12 months. Every time a company issues common stock, that dilutes the current shareholders, making your shares less valuable. Their latest financials are as of April 2021, but they did a recent capital raise for $5 million in June. The company raised $5 million. For 50 cents, they sold one common stock and one warrant. And it looks like this is in US dollars. A warrant is like a long-dated option. So if you pay 50 cents, you would get one share of common stock and the option to buy another share for $1 anytime over the next 3 years. If the stock price didn't hit $1, you would not exercise the warrant because you can buy the stock in the open market for lower than $1. But if the stock price broke through $1, even if it went up to $100, you can pay just $1 for a share. This is the equity section of the company's balance sheet. So they raised $22 million from issuing stock and they lost $22 million from running their business. So when a company loses a similar amount of money as they raised, that's a sign they're headed towards bankruptcy. Since this is a young growing company, they're expected to lose money, so they're going to need to continuously raise capital. As long as investors are willing to buy the stock, they're not going to go bankrupt. But if the capital markets froze up and people were not interested in buying their shares, then they would go into bankruptcy. Right now, there's plenty of money being thrown around, so I don't think there's any risk of them going bankrupt anytime soon. Let's look at the capital structure. They have $2 million of equity, $100,000 of debt. So they're 96% equity, 4% debt. Their net debt is negative $2 million. So they could pay off all the debt with the cash on their balance sheet and still have $2 million left over. Their weighted average cost of capital is 12.5%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $170 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $110 million. We divide that by 399 million shares. We get a calculated stock price of 28 cents. So I didn't really value the company. I just showed you what their free cash flows would need to be to justify a 28-cent stock price. So if they hit break even in 2025 and they generated 17 million of free cash flow, the average company converts 10% of their revenue into free cash flow. So that means they would need to have about $170 million of revenue to get 17 million of free cash flow. Do you think they'll have $170 million of revenue? If you think they're going to have more, then you should buy the stock. If you think they're going to have lower, then maybe you shouldn't buy the stock. I know there's potential for them to get a lot more, but there's a big difference between potential and reality. This is where the stock has been trading since 2015. At 2 points in time, the stock did break through $1. And it got really low, down to 1 penny. Since the company's not making any money, the stock price goes up or down based off of news reports, based off of what the company says, based off of other EV companies, based off of the entire industry. I really hope this company becomes successful, but who knows? No one really knows for sure. We don't have a crystal ball. Anything can happen. This is where the stock has been trading the past 12 months. So it was 1 penny 12 months ago. Now it's 28 cents. Usually the stock jumps a lot when they enter into a new agreement with a company, and then people sell off and the stock price comes down. So obviously investors aren't waiting for a company to make tons of money. A company could be losing money for a really long time and still get a lot of investor interest. And some companies like this are bringing in no revenue and there's still investor interest. And if the company is successful, those investors who invested in them early will be handsomely rewarded. But for every company that's successful, there's 1,000 companies that are not successful. This stock has a negative beta, so it moves opposite the market. The stock has gone up a lot the past 52 weeks, up 2,700%, while the S&P 500 is only up 33%. And it has a really big spread. The 52-week low was 1 cent, the high was 95 cents. On a dollar value, that's only 94 cents, but on a percentage value, that's huge. The stock is in a decline. It's trading below its 50-day and 200-day moving average. When the 200-day moving average crosses above the 50-day moving average, which this has, that's called the death cross. That's a bearish signal. About 2 million shares are traded each day on this stock. Of the 399 million shares outstanding, 378 million are on float. Only 1% are held by institutions, and 1/3 of 1% of the shares are shorted. In the past 3 years, the stock is up more than its industry and the market, but in the past 5 years, the stock is down. The president and CEO of the company owns 5% of the stock. Then Vidant Investment owns 0.72%. Then Murray Asset Global. Then another executive at the company, Cedric Wilson. And last is FNY Investment. Since the company is pre-revenue, we can't look at the PE ratio or price to sales ratio. They have a pretty weak price to book ratio of almost 55, much worse than the market median and average. They have a pretty good current ratio and quick ratio of 2.0. They have about $2.2 million of cash on their balance sheet, but this doesn't include their recent capital raise of $5 million. That happened in June. These financials are as of April. So the company will definitely need that $5 million they raised in June because they had negative $5 million of free cash flow in the trailing 12 months. So the company is going to need continuous funding to pay for the expenses of its everyday business. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 32 companies in the same industry as Extreme, and they have really bad ratios since they're pre-revenue and they're such a young company. Only their current ratio and debt percentage looks good. The rest is really weak. So to summarize, I think this company might have a great future, but it's really difficult to grow organically. They need to really build relationships with other companies. If they could build a relationship with Tesla or Ford, that would be a game changer and their stock would go through the roof. If they can supply their technology to those companies and each car was equipped with their technology, it would be amazing. But you do run the risk of giving out all that information and the company doing something similar. Maybe not copying it, but doing something similar where they cut you out of the picture. And I read on the message boards, people are really excited about this stock. They want it to go up a lot because obviously they want to make a lot of money. But it's not an easy industry. It seems like that technology is great, but execution is the name of the game. Ideas are meaningless. You really need to execute those ideas. And it seems like they're doing a decent job so far, but they haven't brought in any revenue. I know it takes time, but I'm really excited to see how this company evolves. I rank their free cash flows, revenue, and ratios 1 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.